which is basically guidance given by ICSI, which is recommendation to strengthen corporate governance framework, which is old version, but it talks about what really goes about in remuneration, and you can maintain documentation which would actually show remuneration policy of the company, appraisal mechanism, a lot of these aspects. So maybe this is some kind of reference, but again there is no particular way. I would feel that a transactional net margin method could only be a supporting method rather than the first method for that.
Now, let's be very clear about the fact that the Indian company has 25% shareholding of the foreign company. It's a foreign company. And Rohan has pointed out that for the purposes of 48(2)(b, the residency is not important, and Rohan has also referred to bank branches situation. To my understanding, all these bank branches, they are covered under permanent establishments. And for PE, I am sure that they can be covered. Now the issue here is whether 20% or 26% what should be taken as a threshold for deciding that whether 48(2)(b will apply or the international transfer pricing will apply. I think 48(2)(b is a general rule and 92 is a specific rule. So which rule will prevail? I think that's very clear that a specific rule should prevail. And if a specific rule prevails, then it is 25%. It is less than the threshold of 26%. Of course, 48(2)(b somehow it can be covered. Yes, of course, I think it can be covered because it is more than 20%. But international transfer pricing should not apply in this situation, to my understanding. Second question is about the remuneration, which is very simple issue, but the most difficult issue. As I say, that top is the easiest method, but most difficult to apply. Same is the situation in remuneration. That remuneration is such a simple transaction, but where from you will find good comparables. Comparables which are unrelated party, uncontrolled transactions, and similar kind of comparables, which is very difficult. And the best thing that Rohan has suggested is TNMM. I think for remuneration, it's very good, because then just for the sake of remuneration, we cover all the transaction of the entity. Good leverage to the tax part.
Technically 48(2) covers it. So I'll give you a brain teaser. 92BA says, for the purposes of this section and section 92, 92C, 92D and 92E, specified domestic transaction in case of an assessing means any of the following transactions not being an international transaction. So what do you mean by not being an international transaction? Is it international transaction as defined under section 92E, or is it the characteristics of the transaction under section 92B? That means it is cross-border, not between two associated entities. I am aware of that. So can you therefore say, now this is something extremely stringent, you can't say it, but I am just trying to give you some food for thought. Because we all have to start thinking, friends, it's like this, that if a transaction escapes a particular mischief of the law under section 92, which is more specific, can the law then rope in that transaction under a general mischief? So that's the tussle between a specific section, a general section, specific mischief, general mischief. What will prevail in law? That the law alone knows. The courts will tell us. On the face of it, it gets covered under section 48(2). And I think for remuneration, all the reasons have been stated by my co-panelists. But I think there is one very good other reason which I believe should also help in the benchmarking, is that there is no arbitrage of tax. One is a loss-making company, so there is no question of shifting profit the other way around. That means if I would have not taken any remuneration, then actually I would have probably been in profit, and to that extent I would have set off my carried forward losses, because the losses are there since many years. So therefore, one of the things that we have to see is domestic transfer pricing is, and that is also referred to by GlaxoSmithKline. It is referred to that old circular which Rohan said, that if there is no arbitrage of tax, So what is the arbitrage? 33% versus 35% or something? That's corporate tax. So there is not much of arbitrage. It is not that there is tax holiday and there is no tax and there is tax payable on the other side. So where there is no tax arbitrage also, where there is tax neutrality, then I would believe that the transaction is inherently at arm's length. Just any views on that particular perspective from my co-panelists?
I wish that there was a precondition of tax neutrality or tax avoidance motive in the domestic transfer pricing. That would have been better.
But actually that was the objective, if you look at the Supreme Court decision, it actually outlined certain circumstances which was eroding the tax base, and that was what the focus was. But
Yes, Glaxo the things are very, very clear. In fact, the main issue that was referred to is by the Supreme Court. That was not the main transaction of domestic transfer pricing or something. It was just a thought. And GlaxoSmithKline has given so much to the professionals that we should all be having wonderful business for next 10 years.
That's a nice one. Next
Next case, we go. Thanks.
question on this.
last, Paresh, if you take it last, will be better.
Thanks.
So here we are talking in the case study 3, we are talking about a partnership from Mehta Modi Investments. Here, of course, this difference is the remuneration is 4 crores 50 lakhs, and I'm assuming that is the amount that is paid to BK Modi, because there's one line is talking about 4 crores 65 lakhs. Anyway, so to that extent, in terms of the remuneration paid to BK Modi, if we have to really compute the net profit before remuneration, it would be about 4.75 crores. Now one has to look at, to my mind, the deductible limits under 40B, which is a very specific provision. And as per that provision, it comes to about 2.88 crores. So to my mind, the DB provisions or the obligation to prove the arm's length or to apply to the 2.88 crore amount, purely because the sections of 40, the provision section 40B, to my mind, will overrule the provisions of 48.2. In fact, there is a Karnataka High Court decision of NM Aniya and Company, which actually says that provisions of section 40B are specific, while that of section 48.2 are general. Since provisions of section 48B are specific, they will override the provisions of 48.2. This is despite the non-obstant clause in 48. So that's the first part. The other aspect is about, of course, the reimbursement of traveling cost, which is 5 lakhs, which ought not to be a problem, because there would be clearly evidence that would be available from the third party. So that's not an issue at all. In terms of the interest on capital paid to another partner, KK Modi, and again I am assuming all this that the answers are being provided on the assumption that the payments are duly authorized as a partnership deed, because that's again something which is assumed. So again on the interest on capital, ALP analysis will have to be done, like how we do for any other any such transaction. However, under 40B again there is a maximum cap of 12% on interest that can be paid. So that again has to be kept in mind. In another transaction, SK Modi, wife of TK Modi, there is the interest on loan of 11%. I would believe that that transaction would get covered as a relative of partner SK Modi, and that transaction ought to get covered under 48(2)(b). However, the cap will not be triggered here under 40B, because she is not a partner to that extent. So the rent to trust also, to my mind, would get covered, because the trustee would be actually the representative assessee, and which is DK Modi. He would be the representative assessee, and he being a partner in Modi's investment becomes a related person, and would get covered under 42. So the rental payment to a trust would fall under purview of the deed.
Okay, I will start with right to trust because Rohan's view is that it will be covered. But I understand that trustee will be basically acting in a fiduciary capacity. So whether he will be a representative of SSC or representative of SSC for the purposes of that, or can we make him? I mean, can that person be covered? Trustee can be covered under 48(2)(b. I'm not very clear on this. I mean, this will be the right person to address this issue, but that is my thought. 40B again, yes, it should prevail because 40B and 48(2)(b, of course, the specific sections should prevail. And interest on capital and interest on loan, of course, I mean, not very many issues. But trust, I think Ms. Pillai should address this issue, whether trustee can we really cover that.
So therefore, I think there is clarity on one aspect that 40B is more specific, so there is a statutory limit. So does it therefore automatically mean that, for example, the statutory limit on interest on capital is 12%? So does it therefore mean that 13% is not at arm's length? I believe not. But at least there would have to be evidence shown, because on the face of it, it is beyond the statutory limit. So can you disallow it at the 48(2)(b) just because the statutory limit of 12% is there, or would the general principle still apply? I would believe that there should be an opportunity given why that 1% more is paid. So though there may be a disallowance under 40B, it's controversial that generally speaking 40B more specific prevails. There's a Karnataka High Court judgment, there is also a Gujarat High Court judgment, 351 ITR 156. Great City Manufacturing Company. So therefore, there is no doubt about on this, so therefore there is reasonability that 40B remuneration covered, because there is no arbitrage in the sense that there will be, it will be taxable in the hands of the partner, what is allowed as a deduction, and both are at same level, taxation, 30%, irrespective of surcharge. So, I mean, to that extent, it also gets economically covered under tax arbitrage. And now we come to trust, very interesting question. If you read specified persons, I don't believe trust gets covered. If you want, I can get into it, but I don't know whether we have the time to get into it. I'll just try to tell you. When you go to section 48(2)(b), you have to be very specific. So therefore, for example, in our case, as we are reading a partnership firm, at best, the clause under subsection B that will get covered is not 1, not small Roman 1, not small Roman 2, because Roman 2 firm, but there is no member of the, no payment is being made to the partner of the firm or any relative of such partner. It won't be Roman 3. Can it be Roman 4? And the problem over here is that when you try to go to Roman 4 and you say who has substantial interest in the assessee, the trust does not have substantial interest in the assessee, so 4 is not available, 5 is not available, I would believe. Here also is the opposite, someone having interest in the firm, maybe 6 gets covered, but then the point over there is that when 6 gets covered, is a trust. The first question, is a trust an AOP? And the answer is no. And is a trustee a member of the AOP? No, he is only in a fiduciary capacity. So therefore, my belief is that trust is not covered, and for that you can also refer to Shankar Trading Private Limited, Delhi High Court, 2012 76 DTR 76 DTR 40. And what is the purpose behind that? Is that what is an AOP is different. Even group of trustees are not an AOP, because though there is an amendment to section 231, I am aware of that it is not necessary that you come together to do only business under section 231. Definition of a person, but the important part is that trustees are in a fiduciary capacity. They are not members of any AOP, and the representative capacity only under section 161 is only for taxing and not for any other purpose. And I think we can close it. Any other view on this? I'll be happy to take it from my co-panelists. So now we come to the last case study, a very interesting one. And before we go there, what is the reason that we have tried to keep this case study very interesting one? Because we are referring to this case study on section ATIA 8 and also ATIA 10. And this is an interesting one because there are nuances to this, and I think we can dwell on this because now there is the question of market value for an intra-firm, and there is inter-unit and also intra-firm, means intra-company. So both are covered because then there is also the question. There is also the question over here, and I think Pramod put up that question when he was discussing Form 3C. What is close connection? So we are trying to rope this in. How do you try and rope close connection in a particular aspect on the facts of that case? On the facts of that case. There is no general law for close connection. There is no definition. Even the case laws on ATIA 10, few which are available, have not dealt with close connection. So we are trying to deal with close connection. It's interesting. Let's hear our friends on the panel.
Okay, I'll just briefly summarize the facts because this is a bit, a lot of factors are there in this. We have a company XYZ Industries Limited which has got electricity division ED, which is the eligible business for the purpose of tax holiday. The XYZ Limited also has a textile division, which is TD in short. The electricity division has transactions of sale of electricity to its textile division at 6 rupees per unit, with another related company ZYX at 7 per unit, and it also has a transaction with the State Electricity Board, which is a grid, at 5 per unit. The State Electricity Board further sells the electricity to commercial users at 7 per unit. So the end price for commercial use is 7 per unit. So the transaction in this case, and there is another transaction of ZYX selling some byproducts to the electricity division. So briefly, the transactions are sale of electricity by electricity division to the textile division at 6 per unit. Now, to that extent, the sale of electricity represents provision of a marketable service, and hence could get covered under section ATIA 8 with respect to the sale of textile division. In respect of the sale of electricity by ED to ZYX, it would get covered under ATIA 10 in that subsection. Now, if you look at the arm's length price, I would believe that the price at which it is being sold to the State Electricity Board at 5 rupees would not be an arm's length price, and hence the price ought to be 7 rupees. And in which case, when you are actually transacting between the related parties at 6 rupees per unit or 7 rupees per unit, it should not be a problem because you are actually selling at a lesser rate than the arm's length price. So that should not be a problem. In terms of the sale of byproducts by ZYX to ED, I would believe the same thing, that while income cannot be imputed in the hands of XY on account of free sales, it needs to the first aspect that we thought, because the computation of income cannot be imputed in this case. However, one needs to evaluate the impact of disallowance under section 27(1).
Ajit Bhai told me that he tends to just believe that there are these provisions of ATIA 8 and 10. I just take them out in little more detail. Okay, fine. So now the first thing is that there is a question of section ATIA 8, it has been covered by one, where there is a sale to the textile division at 6 rupees per unit. Now, the second question is that there are transactions with ZYX. So is ZYX close connection? Therefore, when the definition of close connection is not there, can we say that it is reasonable to understand that the persons covered under section 48(2) and section 92(2)(a), 92(a), subsection 1 and 2 would constitute those people or those persons who could get connected to close connection, and I would believe that where a particular word is not defined in the statute, then you can go and take benefit of what are related persons under the law or associated enterprises to find out whether there is a close connection. And therefore on that ground, because the directors of XYZ together hold equally in ZYX, you could say that XYZ and ZYX are closely connected because section 48(2) would apply. And for that, you can also refer to Form 10C(b), which talks of gets covered. And now, when we come to the particular perspective, then what is the arm's length price? When the electricity division supplies to the grid at 5 rupees and the grid supplies to 7 rupees.